Welcome back, traders and investors. We have Stephen Place here, who is head of investing with options, a professional trader specializing in swing trading and equity options. Likes to exploit quantitative models and technical analysis while minimizing risk through portfolio hedging. Steve, that sounds like a lot of work there. How you doing this morning?
Good. How are you?
I'm doing good. I'm doing good. So, I mean, options can be really complicated and they can also be very simple. How did you get introduced to options and how did you educate yourself?
Well, first off, that intro does seem awfully complicated. Probably need to simplify that description down a little bit. Um, I started with options when I wasn't satisfied with the whole buy and hold kind of idea. I'd come from more of a Bogle kind of investing style. Go with what you know, and everything like that. And I discovered derivatives. I discovered futures trading. My background as an engineer, I'm a recovering engineer, did help me to understand options a little bit better. There is something related to option pricing that I call the giant bell curve, where option prices are based upon the assumption that stocks will move in this bell curve. And a lot of the times they don't. Many times, in my opinion, most times they don't. And that's where you can get your edge. When you can figure out when an underlying stock or an instrument will trade outside of that bell curve, or if too many people are overpricing risk and the bell curve is very wide, you can make money as long as the stock stays within a certain range. And that's sort of my approach with the options market.
Okay, were there any particular books or authors or traders that you followed earlier in your career to get introduced to it?
Well, when I started off looking at derivatives and general futures trading, John Carter was one of those that sort of started me on the path. And I transferred more towards options just because I felt like I had an affinity towards it. Macmillan and his massive Bible, Options of Strategic Investment, is a very good book to read with that. Natenberg's book, what was it called? Option Pricing. I'm looking at my bookshelf right now.
Okay.
Uh, Jeff Ogden has some pretty good instructional books out there as well. And Ian Sinclair has some very good, those are a little bit more advanced, more towards the institutional side of things, but that also is he's a very good author around that as well. And if we're going with books, some of my colleagues, Mark Sebastian and I believe Dennis Chen, have a really nice book out, Trading Options as a Hedge Fund, which goes more towards income trading with butterflies and iron condors and things like that too. So that's definitely a good read as well.
Steve, I follow you on Twitter at Stephen Place, and I can't remember what day it was, but I one of your tweets said it doesn't matter that the VIX is low. There's still fear in the markets. Give us your outlook of the markets right now.
So I'm glad you brought that up because that's what I wanted to talk about. So many people are so hilariously wrong on the volatility market right now because they only think about the VIX, but the VIX is just one volatility reading. It's just for the S&P 500. Well, the S&P is at all-time highs. The actual volatility in the market is in the gutter. Where's the real risk? Where's the real fear? And it's in the Russell, right? This has been a bifurcated, it's been a split market, right? There's been a lot of margin being used, right? And a lot of that margin has been focused on small caps. It's been focused on high beta tech. It's been focused in biotech. And all of those got hit really hard over the past few months. So if you look at the Russell's been hit. It is nowhere near 52-week highs. Volatility is really hot right now. And if you look at the VIX for the Russell, and this is called RVX, so Romeo Victor Zulu, you can see that it's nowhere near 6-month lows. It's continued to make higher lows as people have been buying protection in the Russell because they're smart about this, right? They're not buying protection in the S&P because the S&P hasn't been dropping. So to say that there is extreme complacency in the market is not correct. Once the RVX comes in and comes into that 15, 16 area, then I would say, maybe the volatility markets are signaling a little bit more complacency. So until that happens, it's very difficult to suggest that some sort of a contrarian top is due.
Do you, newbie trader inside the chat room has a good question, and anyone else that has questions, please make sure to chat them in. We'll get them answered for you. Does volatility really equal fear?
Most of the time it does. So you've actually got two kinds of volatility. You have the volatility that has actually happened, and this is what we call historical volatility. And then we have the volatility that people think will happen in the future, and that's what's being priced into the options market, the implied volatility, the implied move. Now, with commodities like gold and oil and natural gas, if you look at those options markets, sometimes you'll see the fear is both to the upside and downside. Right? There are firms and, for example, airliners don't like it when oil spikes higher, so there's fear there. And so you can see implied volatility rise as that market rises. But generally, if you're an institutional investor and you need to protect yourself in equities, in stocks, you're going to protect yourself against the downside, just because that's where most of your positioning is. And what you'll find is that when stocks do sell off, the actual volatility also increases. So there is a very strong negative correlation in volatility and price movement. Now, that's not always the case, but most of the time it is.
So, Steve, what strategy do you employ with your options? Is it spreads, or are you're buying puts when you don't like a stock, or what do you look for?
Okay, I've got a framework. Most of my capital goes towards income trading. So that are things like iron condors, butterflies, calendars, depending on what kind of market we're in. Then I have swing trading, and that can be spreads or it can just be buying calls straight up. And then I have more speculative weekly option trades, and that includes buying volatility on weekly options. Instead of trying to guess a direction, I just buy straddles. And what you'll find is that weekly options especially have a very, very low risk premium associated with them because everyone and their mother is selling those options. And once that premium gets low enough relative to basically the daily volatility in the stock, then you can buy straddles, and it's a very low risk play. Facebook's a great example where Facebook will move 2 points a day pretty much, and we get to around Tuesday or Wednesday, and the straddle that expires on Friday is going for underneath $1.50. So if you could buy a straddle for $1.50 and you get $2 worth of movement, that's going to be a good trade.
And do you try and, when you have a straddle on, do you try and leg in and out of it? I mean, because a stock like Facebook moves a lot, or do you just try and put it on for, if you put it on for $1.50, you try and take it off at $3 and get out at 75 cents if it goes against you?
Basically, yes. I don't leg in. If I wanted to play a direction, then I would play a direction, but I'm trading volatility. With Facebook and things that are priced a little bit lower, I like to trade stock around the position. So once Facebook sees a decent move higher, I'll short stock against it. If it goes lower, I buy stock against it. And that helps to reduce my directional exposure while keeping the whole long volatility idea working for me.
Could you just explain, go into that in detail? Because Dennis and I have talked about that a lot. If you have options on in a stock and they're not quite getting to your strike price, or maybe you identified an institutional seller at a level, could you just go through that real quickly? Maybe using like Facebook as an example here. Maybe if you put on a 62 straddle or something like that, could you just give a little detail on that for our listeners, please?
Sure. So let's say you wanted to buy a straddle at 62. Facebook in the pre-market is trading at 61.80. So you buy a straddle at 62. Maybe it's going for $2 right now. I don't know. I don't see the pricing right now.
Okay, just example. Yep.
The technique of trading stock around what's known as a long gamma position, like straddles, is known as gamma scalping, where you take your directional exposure off but still keep your long gamma on. So what I like to do, especially with long straddles, is that I don't. If I am going to use stock to trade around a position, I'm not going to do it from a discretionary basis. I have set points around, I fix them around my profit and loss of the actual straddle, and then I say, okay, if Facebook rallies $2, right, I've basically got a break-even trade at expiration, but if it reverts, then I go into a loss. So I will take I don't do a one-to-one basis. A one-to-one would be shorting 100 shares of Facebook for every straddle. I would look at about two-thirds. So about 60 shares of Facebook, maybe 70 shares for every straddle. If Facebook continues to run, I make more money. If Facebook sells off, I lose a lot less money compared to if I didn't hedge. This strategy in particular is great if you trade around earnings and you are long straddles or you're long calls into earnings and you see a stock pop, but it starts to run out of steam and it starts to revert. That's when you put on some stock positioning to, it effectively hedges against any sort of mean reversion.
Okay. Also, just going into the Greeks, things can get really complicated when you get to deltas and the gammas and the rhos. Did you try and now you're an engineer, and this kind of reminds me of Nick Shaheen here. You called yourself a recovering engineer. I don't remember seeing that in the dictionary. But did you try and learn them in phases, or did you try and learn them all together?
I did not learn them in phases. I sort of had it options when it comes down to it's very graphic, not like gore and violence. It's very when you learn it, visualization is going to work the best. So understanding what a risk graph looks like and knowing that, for example, the delta is basically the slope of the curve. Okay, delta is technically the first derivative, right, if you want to go into calculus. I'm a recovering engineer because engineers tend to overcomplicate things. So I try and keep it as simple as possible because if I overcomplicate things, I lose money. So, for example, the delta is the slope of the curve. If you make money when a stock rises, you're long delta. It also means your slope is long delta. Now, with gamma is the second derivative. It's the curve. So if your curve is pointing up, you're like a straddle, you're long gamma. If your curve is pointing down like an iron condor, you're short gamma. And that's, if you're just looking at a risk graph, you can see that much more intuitively. And then you can, as you get into more complex options, you can just basically look at a risk graph and you can visualize, okay, I'm long delta. If I get to this point, my deltas are too hot and I need to adjust my trade, and you can go from there. Vega obviously is a whole different animal and it gets a little bit more complicated there. But the general idea is, instead of trying to do all the fancy math, just draw a picture and you're going to get it a lot better inside your head.
Hey, Steve, and I've watched actually several of your webinars on the Greeks and how you trade that, and your education is really phenomenal. I read recently, too, a post you had on Amazon and how you were playing it. I know that was about a week ago, but are you still looking at any kind of play on Amazon right now?
And what we're seeing right now in a lot of these large cap tech names that have gotten hit really hard, we're seeing what I would consider counter trend rallies. Amazon's a great example. Amazon was trading at 410 6 months ago, traded down to 300, so pretty decent move to the downside. What I'm looking for is a little bit more of a squeeze higher in some of these, and I'm looking to get very, very lightly short in some of these names. The way I'm going to do that is to either look at iron condors or I'm going to look at butterflies or calendars, one of those. So it's going to be an income trade where for example, in Amazon, if we get up to that 320 level, I'm going to be looking at something like a July, maybe something like a 360, 370 bear call spread coupled with a 280, 270 bull put spread. So an iron condor that makes money within a certain range. Income trading's worked very well in 2014, but those kinds of strategies are great after a stock has already seen a move to the upside. The upside risk is the biggest risk with income trading, so I'm waiting for a little bit more of a squeeze in that name.
How are you choosing your expiration dates?
So with income trading, I'm looking about 2 months out. So between about 75 to 50 days to expiration is generally what I look for. For iron condors, just a quick tip for those that are interested: the delta of your option dictates your consistency. So the only way to be consistent, Amazon moves a certain way, Walgreens moves a certain way. In order for you to be consistent, you can't just say, "Oh, I'm going to buy a call that's 5 points out of the money." You have to look at the deltas. So an iron condor would be a 15 delta short strike for me. So I would go out to the options market. I'd go out to July. I'd look for the 15 delta put and the 15 delta call, and I'd short those, and then I'd buy the wings.
Everybody, we have Steve Place here on with us from Investing with Options. I've known Steve for a while, and if you have questions for him on any of the stocks or setups that maybe you're trading, make sure you put them into the chat there. All right, Steve, we asked you about Amazon. What about any other stocks you're looking at right now that seem to be good setups for income trades right now?
Let's see. So I'm in one in Google right now, and I'm taking a little heat on it. Well, it's barely break even, but Google's seen a very nice run. It's got some pretty clear resistance. It's got some pretty clear support. So one of the things that I like to do is to not get into a full position initially, is that I call it a tier, right? You do tier 1, tier 2, tier 3. So the Google trade that I like is what's known as an iron butterfly, and it is selling the 565.20 bull put spread and selling the 555.20 bull put spread and the 555.80 bear call spread. Total credit is around $22, maybe a little bit more than that right now. This trade makes money if Google stays between 530 and 570. I know that it can easily, 572. Looking at Google right now, it can easily get above 570, maybe run to 580. So I haven't put on a full-size position yet. I've only put on 1/3 of my size. If it rallies up to 570, I will add another round of butterflies. That way, if it does start to revert, I get theta profits, I get time decay profits from both butterflies at the same time. And that way, because I've been burned so many times putting on income trades and then we just squeeze higher, 2013 is a great example of that. So this is a little bit more of a cautious way to put those on.
Now, how do you decide when to be cautious like that, though? Why wouldn't you just let it run?
For Google, for example, we had seen so many of these high beta tech names get hit so hard, it failed to break down, it failed to lose that 520, 510 area, and it started to effectively break out. And it's one of those things where it does require some butt in chair time. This is a little bit harder to explain. This is a little bit more discretionary, but it felt like we were going to start to see a squeeze in those NASDAQ names. And so we did in Google. Google put in a double bottom pattern. It's fulfilled the height of that pattern right now, so I'm expecting it to cool off a little bit right here. But I was expecting to be wrong, simply because we had sold off so hard over the past few months that if there was a counter trend rally, it's going to go higher than what I expect, simply because we've seen that many times in the past.
Okay, just go into overall, stock selection and, looking at your models. Do you follow like a core group of stocks, perhaps stocks in the S&P 500, and then you wait for setups in those stocks? Or are you just more open to following the whole universe of stocks and then, have your scanners and your filters pick out the stocks based on the criteria that you've created?
Sure, and it's a little bit of both. For income trades, liquidity is king. You cannot do income trades in places where there's only like 1,000 contracts traded a day. It just doesn't work. The spreads are too wide. You're going to get hit. It doesn't work. So I focus on the most liquid names for income trades. I tend to focus on for income trades specifically stocks that are over $100 in price on an absolute basis. and mainly tech names, I guess, and the
Mm-hmm.
indexes. So, the S&P cash isn't the most liquid anymore, but it still works. And then you've got stuff like Amazon and Google and Priceline, and those work fairly well. When it comes to directional trading, I have filters and scans. I use a lot of volatility-based filters. So if a stock is in a trend, but it's been compressing for a while, the Bollinger Bands will pinch in. So I will look for stocks that have a very pinched-in Bollinger Band, but are still in uptrends. That is a compression breakout pattern. LNG is a great example of that right now. And I've been talking about LNG for, I guess, 2 weeks now, where if it breaks 60, it should run to 65 right here, simply because it's in a strong trend, it's been compressing. So things like that. I also look for parabolics, so stocks that have been breaking out above their second standard deviation Bollinger Band. Also a good, it effectively shows you the actively traded stocks out there. And I also use just simple relative strength screeners, where if a stock is trading 5% within its 52-week high and it looks like a good pattern, it's probably going to continue in its trend. And playing relative strength stocks coupled with income trades is sort of my bread and butter trading strategy.
Okay, and also when it comes to technical analysis, I heard you mention the Bollinger Bands there. Are there any other, and you mentioned the relative strength. Is there any other technical formations that you like to follow?
Simple, traditional technical patterns work most of the time. Because this market has been reverting a lot more, a lot of failed breakouts, there's a very specific setup called a 2B reversal. It's also known as a failed break setup, where if there is a captain obvious level of support, the algorithmic traders as well as other smart traders will run that support level. It will flush out all the stops because people say, oh, if the support level is broken, I'm going to get stopped out. And then they flush the stops and then they reverse it hard. So if you can identify the captain obvious level of support and look for the flush, and then wait for the reversal, normally it goes back to the top of the range. And that has been a very powerful pattern pretty much this entire bull market, simply because back in 2009, for example, we had that obvious head and shoulders top, and I tried to short it, and it failed, and then I got stopped out really hard. That kind of idea continues to work.
So, Steve, if we got a lot of different ranges of traders in our chat room and people that watch the show. For a lot of the newbie traders, even myself in options, what is your best piece of advice for them when getting started?
Don't be concerned about the complexity of the trade. If you focus on the Greeks, right, then you're going to understand it. Remember, Greeks for a complex spread are an aggregate. That means you just add them up. So if, for example, bull call spread, if you buy a 50 delta, okay, option, if you buy a 50 delta call and then you sell a 30 delta call, your net directional exposure is 20, which means that the stock moves up $1, you make $20. And then you can do the same thing with theta and gamma and everything else like that as well. So it's a lot simpler than you think, especially if you just figure it out graphically. If you can visualize it in your head, you're going to do a lot better.
Okay, we've had Stephen Place on, investing with options, giving us his take on the market, different ways to capitalize on the movements in stocks, capitalizing on the volatility, and also when stocks are just sitting still. So, Stephen, thanks a lot for coming on the show today, and certainly like to have you on again.
Thanks for having me.